And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Thursday edition. It's the second best day of the week for The Real Investment Show. Love Thursdays. Thursdays are great. Friday, it's here. Even working on a Friday is not bad because you know it's Friday, right? I mean, it's just all good. Couple of good things yesterday, of course. The Federal Reserve announcing their rate hike, and as we noted yesterday, we said that if the Fed pretty much met expectations, which was a 50 basis point rate hike, and they're tapering their balance sheet by $90 to $95 billion a month, that markets would likely rally because that's what markets were already expecting. And I said, but if we got some good news, right, a little bit of a dovish stance to the announcement, that could really spur a rally in the markets. And yesterday morning, the markets really kind of just flopped around all day, kind of waiting for the meeting. At the time of the meeting, at the announcement, markets kind of vacillated back and forth, right around break even, really more or less, as the Fed did announce the 50 basis point hike as expected. And everybody's kind of holding their breath, though, for the press conference. And this is the big moment. This is where Jerome Powell, of course, comes out and makes all of his statements about what's going on in the meeting. Well, what was the dovish surprise, we shall say, is two things. One, the rate of the taper is actually a little bit slower than was previously expected. It was expected that in June, the Fed would start by tapering the balance sheet by $90 billion, but instead they're going to start at about $47.5 billion and then roll that up over a 3 or 4 month period to that $90 to $95 billion cap. So that was a little bit slower of an advance. So that was kind of good news for the markets because now they're not going to take away so much of the punch bowl right up front. But the second thing, and really the thing that really spurred the markets, is that Jerome Powell ruled out the 75 basis point increase entirely. So this really kind of set the markets up for this. And yesterday, the interest rate on the 2-year Treasury fell sharply. Now, this is very important because the 2-year Treasury rate leads the Fed funds rate. And if you go back in history and look, wherever that point is that the 2-year Treasury rate starts to fall, that begins to really cap the ability of the Fed to raise rates. So the sharp fall off yesterday in the 2-year Treasury is going to limit how far the Fed can actually hike rates based on historical analysis. Now, the other side of this, of course, is that kind of dovish news did actually spark a fairly decent short covering rally. And the reason that we said we'd likely get a very strong rally is because of the extreme negative sentiment that we have in the markets right now. If you take a look at the net bullish sentiment, that's at the lowest level, basically, of any bear market bottom, 2008 to the dot-com crisis, you name it. We have negative investor sentiment at levels that are normally associated with bear market bottoms, not corrections. It's just how negative investors are right now. So between that, light positioning, fairly illiquid markets, we've got very limited liquidity in markets. That really led to this very sharp rally yesterday. NASDAQ, S&P up 3% yesterday, a huge 3% rally. That did a couple of things here, of course, as we kind of talk about the markets itself. Again, did solidly trigger the money flow buy signal that we've been watching here lately and needing that to turn up. That money flow buy signal now turning up from a very low level. So this is going to provide a bit of fuel here now. This morning, futures are pointing a little bit lower. Dow's down about 133 points. S&P right now down about 23. That's not surprising. After a 3% rally yesterday, there were a lot of people that were trapped in this market at these lows, really concerned about where things were going. So this lift that we got yesterday really across the board, and a lot of this in tech stocks, energy stocks, etc., kind of a big, broad rally yesterday. A lot of these individuals that were kind of trapped in the markets looking for an exit, not surprising, seeing a little bit of selling today. It will be important that we continue to get a push through over the next couple of days higher. Now, today we've got some key economic data coming out tomorrow. We have the jobs report for April. So where everybody's going to be watching that employment report, as the Fed specifically noted, of course, they are watching inflationary pressures, but also watching the employment rate. That's their two primary mandates. And so they're going to continue to hike rates. Now, they didn't say they were going to, they were one and done here. They did say they were going to continue to hike rates. 50 basis point rate hikes are on the table for the next few meetings as we begin to move forward. But again, what will potentially mitigate their ability to hike rates will be slower economic growth. If we have indeed seen a peak in inflation, if we start to see lower inflation numbers over the course of the next few months, this is going to start to cause the Fed to pull back here a bit. Now, going back to 2018 as an example, the Fed hiked 50 basis points, and this is kind of that part and parcel timing that we start talking about raising interest rates, trying to taper their balance sheet. They were trying to raise rates and taper their balance sheet in 2018, and remember, about 3 months later, markets were down about 20%, and they reversed all that policy. So as we kind of move forward here, as the economy gets weaker, as we see a peak in inflation, if we do continue to see more trouble with equities as we move forward, and this is an important point, we're not out of the woods by any stretch of the imagination. This buy signal that we're getting right now, and of course, we're very close to triggering a moving average crossover as well. If those indicators turn up, that certainly does bode well for at least a fairly significant short-term market rally. I mean, we could very well see this market push up 300 points. That wouldn't be outside the realm of possibility at all at this point, and that would certainly provide some nice kind of relief rally in the markets. But we still have a lot of concerns going forward economically, earnings-wise. Of course, the Fed is hiking rates. They are removing that support from the markets. So there are still a lot of challenges for equities as we move forward. So as we think about this rally, be careful. What you'll see on the media, of course, is this idea that, thank goodness, the bear market's over, the bull market's back, we need to definitely be in the markets now, and all this talk about recession and bear markets and all that will fade from the headlines, and that's going to be just about the time that we get kind of the next volatility pickup in the markets. And this is going to be kind of, I sense that this is going to kind of be the game book for the rest of this year, as this market that kind of just gyrates around and vacillates up and down. Now, there are some good key bullish indicators here. I mentioned, of course, that the American Association of Individual Investors, those are the retail investors, their net bullish sentiment is at levels that are normally associated with bear market bottoms. And again, we're only down about 10% from the peak in the S&P, and we're talking about major bear market type negative sentiment. The forward returns from historically over the next year from those lows tends to be very positive. Now, that's certainly kind of an interesting position that we're in, considering, again, the market's just been consolidating now for about 9-10 months. We really haven't gone much of anywhere, been a lot of volatility, and as we talked about yesterday with Danny Ratliff, investors are treating this as if they're losing all their money, and we're in the middle of a major bear market, and that's not the case at all in terms of the major indexes. Now, there are certainly stocks that are down 30, 40, 50, 60%. Absolutely, there's some stocks in very big bear markets, but the indices are still holding up here pretty well. We've got a lot of stuff to get into this morning about the Fed, of course, what they said yesterday, a little bit more detail on that, talk about portfolio management going forward from here, talk about some of the economic data as well that's starting to show some signs of real concern, ISM manufacturing, services, and more. We'll get into that this morning with Michael Lebowitz right here on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people of the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Real Investment reinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. It's 6:17. Woke up this morning. Dogs want to get fed. You know, they run back and forth through the house between trying. You know, both of our dogs are herders, so they try to herd you towards the food bowl. So you'll feed them. But my dog has to have surgery this morning. My older dog has cancer, so we've got to have surgery this morning. See how he's. See if it's what the damage is and where we go to from here with that. But he can't eat, right? So like as normally even with humans, right? You can't eat, before your surgery. Yeah. So our dog is now thoroughly convinced that we don't love him anymore because we are no longer feeding him. Apparently we've just decided to starve him to death.
Yeah.
And so
is this Gunnar?
This is Gunnar.
Okay.
Yeah. Yeah. So Sniper, he's completely confused. He's like, "What? Just because you're not feeding that old dog that I really don't like that much, why you're not feeding me? I'm the one you love, right?" So I know. But it's funny because I have to go out the back. I go out the back door of our house. We have a door in the back that leads to the garage that my car's parked in. And so as I was going out that door, my dog gets in front of the door and is literally stopping me from leaving, so I will feed him. So.
Desperate times.
Desperate times, desperate measures. Anyway, good morning, Michael Leibowitz. How are you this morning?
I'm great. Thank you, Lance.
Well, you sound terrible.
I sound a hell of a lot better than I did the last few days.
So a couple of things, as I already talked about this morning, the Fed pretty much came in line with expectations. And, as we had talked about previously on the show, not nearly as hawkish as everybody expected. And came in, saying, look, we're not going to hike 75 basis points and, we're going to actually taper the balance sheet a little bit slower than expected. So not nearly the hawkish extreme that, a lot of even the markets were looking for, but a lot of the mainstream analysts were talking about, it's going to be 75 basis points. They've got to hike faster. Bullard talking about needing to hike faster. Wasn't the case. And that led, of course, as we've been talking about here on the show, with such extreme negative sentiment by investors, light positioning, a lot of investors off sides, that really provided the fuel for a very sharp rally yesterday, which is what we got. A lot of short covering as well was thrown into that. But it's kind of interesting here because now the 2-year Treasury rate, as I noted, is falling fairly sharply. And that's going to potentially limit the Fed's ability to hike rates as much as markets were previously expecting. Your thoughts?
So I think what the Fed always aims to do is convey a narrative. And at times the market is in line with the Fed's narrative. Other times the market is overly aggressive or overly conservative. And I think probably this time more than other times, what the Fed is trying to do is get the market to do the Fed's heavy lifting. The Fed doesn't want to raise Fed funds to 2.5%. They don't really, I'm not sure they want to take 2 or 3 trillion off their balance sheet. I think what they want the markets to do, stocks and bonds, is they want the bond market yields to rise and they want the stock market to fall. They want to take the froth out of the market. They want to kind of knock back some of the investor consumer sentiment to some degree. They want to raise rates, which will help take the edge off inflation. And their approach is kind of a two-pronged approach. Let the market do the heavy lifting and we'll follow up with some lighter lifting. So when we talk about Fed narrative, what the Fed is talking about, it's very important, if that's their tact, to make sure the market is thinking what they are thinking. And what Jerome Powell and the Fed did yesterday in both the statement and the press conference was walk the line. He basically was not overly hawkish. He was not, he really, after everything they put out, you couldn't say he was more hawkish or more dovish, not even by a little. You pointed out that he said we're not going to do 75. Mm-hmm. I know the market had 75 basis points priced in for June. I don't think 75 was ever on the table, and I don't think there was ever a Fed member, other than kind of throwing it out that we could do more, was talking seriously about it. So, I don't really think that was too dovish. But I also, don't think that they could have said, look, there are a couple signs that inflation is starting to stop rising. They didn't take advantage of that. The Fed could have said something about GDP was negative last quarter, which they mentioned in the statement, but then they went on to say, but this, that, and the other. Mm-hmm. So I really think they purposely like the narrative, like what the market thinks the market is right where it needs to be. And because of that, they really didn't stray. And it was, a lot of people said, this is going to be the most important Fed meeting of our lifetime. I told you, I said, this is going to be the most boring Fed meeting of our lifetime. They're going to say exactly what they've said, and the market is priced for exactly what they said. There's no potential for fireworks.
Well, we did get fireworks, though, in the markets, right? I mean, it's you say the markets were priced for what the Fed was saying, but that's not really the case. Markets were offsides, on both positioning as well as sentiment. And the real question now is going to be, and again, you did bring up an important point, which is, let's just assume the Fed is hoping the market is going to do the work for them, and that work has been done. Again, investor bullish sentiments now at the low is at bear market lows. I mean, this is where we saw investor sentiment at the bottom of the financial crisis. Investor positioning is a lot of that same way as we showed in our newsletter last weekend. Our technical gauge that we run for our SimpleVisor clients, that's at levels that is normally associated with bear market bottoms. And so a lot of that work in terms of higher interest rates on the bond market, which is now slowing the housing market. We're seeing ISM slow down fairly sharply on the manufacturing side as well as the services side. Here's my question, is that a lot of that work is being done by the market itself. The Fed is only at 75 basis points off of zero. So, I mean, if we wind up in a recession later this year, they still need to hike rates more so they have the ability to lower rates if we get into a recession. If they're allowing the market to do the work for them and they're saying, okay, we want to raise rates to 1.5%, that still doesn't give them a lot of juice to work with in terms of lowering rates, which is really the only thing that helps economic growth. The QE doesn't really feed into the economy, but lowering rates does, and they haven't really given themselves a lot of room here.
And I agree. I think what you have to think about is this is not like anything in the last 30 years because we're running inflation at nearly 9%. So what the Fed is not looking at is the economy nearly to the degree that they typically would look at it. Right. I mean, I think if this was a normal environment with inflation running 1.5%, maybe 2%, and we just got a negative GDP number, and there are clear signs in like the ISM data, China's slowing, that the economy will be slowing. The new Atlanta Fed forecast is, I think it's like 1.5 or 1.8% positive growth, which is, means the first half of the year will basically have been flat if that holds up. Right. we'd be in an environment where the Fed would probably be like, you know what, we may do 25 or 50, but we're going to back off. We're pretty much at the end. The economy is back to where we want. Inflation is back to where we want. Now we're at a point where the economy may be where they want, but inflation is showing. There are a couple signs, but really there's nothing that really points to inflation has peaked and it's coming down sharply in the months ahead. And even if we say, okay, inflation's coming down, inflation coming down to 6% by November is not the problem, right? It doesn't fix things. Inflation at 6% is still a big problem for the Fed. And because of that, the Fed has to stay on this horse and probably raise rates too much.
Right. Well, and again, then I think this is what we go back to talking about. What is that risk of a Fed policy mistake, and what's the outcome of that? Again, if we're talking about markets have been through a correction, been in a consolidation now for roughly about 9 months. I mean, we're basically about where we were last September in terms of kind of market price, right? So markets have gone up and down a lot. Been a lot of excitement, a lot of disappointment, but really haven't gone anywhere in about 9 months. And if, with sentiment as negative as it is, positioning as negative as it is, if the Fed's going to walk into this and create a policy mistake, there's a lot of damage that's still potentially left to be done in the markets. And I don't know what that outcome is going to look like, or how we need to be positioning for it right now. But, earnings estimates are still going up. It's interesting that despite what's going on, despite the stuff that we're talking about, higher interest rates, tighter balance sheet, weaker economy, and Wall Street analysts are still hiking estimates for companies for the rest of this year, which is, bringing down forward valuations. Forward valuations are now 17.5 times earnings on the S&P. But that's only a function of the fact that prices haven't gone anywhere, and analysts keep ratcheting up earnings for this year and next. I'm not sure how they're getting there, right, Mike?
Right. And that's where we're going to have some sort of potentially further correction, because it's going to be tough for earnings to stay where they are for most companies. Some will see good earnings, but I think a lot of companies are a lot of pressure. They've raised prices. They've done the whole shrinkflation thing. They're limited in what they can do, and it's still the tightest jobs market we've ever seen. You could go back as long as you want, at least in modern history. Mm-hmm. So wage pressure will, at least for the short term, continue, meaning that companies have to raise prices. The cost of goods is still increasing, yet consumers aren't getting paid enough, their money in real terms after inflation is falling. So consumers cannot keep paying for higher prices. And this is where the rubber hits the road. And the stock market still has some potential pain as it adjusts to this reality.
Yeah, and that's actually going to be the big issue here is really the consumer, since they make up 70% of the economy. What happens to them over the next 6, 8, 9 months, particularly as real wages are falling, real retail sales are falling. In fact, I did an interview about this yesterday. We'll talk about that when we come back from the break. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the truth Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The Truth About Life Insurance with Ratliff and Rosso. Realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Good news out this morning. Dr. Anthony Fauci says the pandemic of COVID is now over. So can we please go back to living our normal lives?
Whatever normal was.
So there you go. Mission accomplished. Amazingly, just in time for the midterms.
Of course.
The Real Investment Show podcast. Same show, your schedule.
See, we need to be thanking Vladimir Putin for his invasion of Ukraine.
At realinvestmentadvice.com.
Because it solved the pandemic.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The most important insurance policy you'll ever own is the one you'll have when you die. Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income and protect your real estate. Thursday, May 12th at noon. Register now for the truth about life insurance at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So as we get ready to kind of open up the trading day, we've got a bit of economic data that's coming out today, and then of course tomorrow, Friday, will be the Bureau of Labor Statistics. That's the big job report, right? So that'll be the job report for April. Of course, the markets will be looking into that to see if, because of that first quarter weakness in GDP, is that starting to translate into potentially slower job gains. And what does that job makeup look like in terms of the economy? So are we seeing signs of wages potentially peaking here, wage growth peaking? Are we starting to see, potentially job growth slow, those type of things? So just some indications really to where the economy is relative to employment. And this is, as I left off the last segment saying, if we take a look at some of the economic data, ISM Manufacturing Index, that has turned lower and has been declining and is getting weaker, is suggesting, now it's still positive, right? We're still in expansion mode, but that expansion is getting weaker. And that, of course, is a concern because of, the economic growth that we're starting to see slow down. Saw the same thing yesterday in the services index. That services index has weakened. But importantly, in those indexes, what we're seeing some weakness in is we're starting to see the employment trends weaken. We're starting to see the new orders trend weaken, and those are the important things. So, are these companies hiring more people at the same pace they were, and are the new orders still robust, right? Because again, as we talked about a few minutes ago, 70% of the economy is consumption. So that's me, you, Mike, Brent. That's us going out and buying stuff, putting gas in our car and doing, buying groceries and those type of things. Of course, in order to have that stuff, somewhere that retailer had to place an order for more product, right? So the people that are manufacturing that product to deliver to the retailers to sell to you, those orders are starting to slow, suggesting that maybe demand isn't quite as strong as it was. And this is going to be part and parcel of this outlook. And again, as we were talking about in the last segment with Mike, this is an interesting time for the markets because, again, when you take a look at the negative sentiment, you take a look at the fact the markets haven't gone anywhere over the last 9 months, you take a look at a lot of the devastation in the stocks, there's a case that we could make that maybe the market is bottoming here, even though we haven't really had this quote unquote bear market that everybody's been expecting. But yet there's another case that is easy to make that suggests there's a lot more downside potentially to the market. And we've got this very negative sentiment, but we still have overvaluation in some areas of the market, and we have a lot of headwinds from a slowing economy and higher interest rates. And there's certainly a case that we can make that historically those types of structures lead to bear markets. So this is going to be a very challenging outcome. But let me get over here to Mike just to talk with him a little bit about this economic data. Today we're going to be taking a look at housing starts, building permits, jobless claims, continuing claims again tomorrow, and also the Philly Fed index today. I think we're going to see weakness really kind of across all of those numbers. Mike, what do you think?
I would say except for initial job claims. And I think the jobs market is going to be very difficult to assess for a while. In the JOLTS data, for instance, those being laid off or fired is the lowest rate it's been running at in 20 or 30 years. And at the same time, those quitting is the highest rate it's been in 20 or 30 years. So people still feel emboldened to quit and find a better job. And companies are scared to death of firing employees. So I think we're in a situation where companies have been understaffed for so long and they're finally getting to where they need to be. And yes, they see some weakness, but it was so hard to hire employees. And I think in a lot of cases, those employees are not exactly what they wanted, substandard, so to speak, but they're so scared to fire them.
No, it's
substandard. Yeah, sorry about that if that's you, but
yeah, we just hired Brent, substandard. But no, you're right. Look, companies are always slow to hire and slow to fire. So coming out of a recession, or a downturn in the economy, and they've just laid off employees. They're trying to protect their profit margins, et cetera. And they see the economy starting to recover, and they're like, yeah, things are getting a little bit better, but I don't want to take on an employee because when I take on an employee, I'm doing that from, I'm getting married to these people, right? When you hire an employee, it's not an easy, I got to train them. I got to provide them a place. And then, firing them is difficult because if I fire them without cause, then they file unemployment claims back against the company, and that drives up my unemployment insurance. So when you hire an employee, it's basically a marriage. And so the one thing we see companies do right after, a downturn in the economy is they hire temporary work. We see temporary hires kind of go up. We see movements towards more capital expenditures towards automation. Can I do something instead of hiring an employee? Can I fill that position with automation or some type of other technology to increase the efficiency of the employees I do have? And that's exactly what we're seeing right now, Mike. We're seeing a lot of companies commit some CapEx to information technology, automation, those type of things. We're seeing that occur right now. But you're also correct, absolutely correct, that when you get a good employee, the last thing you want to do is fire that employee, because if he gets a job somewhere else, you're not going to be able to hire him back. and I think good employees are really hard to your point, substandard versus not substandard. Good employees are really hard to come by.
And I think I would argue that if you got a mediocre employee, they're hard to come by. I mean, I'm not kidding. You talk to a lot of people, a lot of small businesses.
Brent caps out at the mediocre level. So
yeah. We've talked about my brother in the printing and marketing business. Yeah. he has hired a lot of substandard employees, and he's thrilled to have them on board.
Yeah.
Not because they're great employees, because he has someone in that seat to do something.
Right.
And I just think about him. It's going to be really tough for him to let go people until he sees a sharp decline in business and just can't afford to pay him, because he's scared of what happens in 6 or 9 months when, if the economy starts rebounding, and he's again in that situation where he can't hire.
No, that's a very factual point, and that's a problem for all companies.
And that's why I think initial jobless claims are going to typically, that's one of the first places you can look in the labor market to see signs that it is starting to turn the other way. Mm-hmm. I could be wrong, but I don't think that's what we're going to see at this time. We're going to see the employment surveys, like the ISM National Manufacturing Survey, basically dropped to almost 50, meaning half the people surveyed, the manufacturing executives surveyed, don't see them hiring new employees in the coming months. That was from 57-ish. That was a sharp drop.
Right.
The ISM Services survey, I believe, went negative. I could be wrong, but it went slightly below 50, meaning more people are actually negative on it than optimistic on hiring.
And that's actually a good point too, because when you take a look at the like the NFIB as an example, the National Federation of Independent Business, that's a survey of small to mid-sized businesses, but primarily that lower tier. They don't survey the Apples and the Microsofts of the world. And you and I were actually having this conversation yesterday, is that really a bulk of the hiring that we're seeing right now is really coming in for the large companies. Small to medium-sized businesses really aren't hiring that many employees because they can't afford it. They don't have the revenue coming in to support more employees. But they're also the ones that are the most immediately impacted by a slowing economy. Again, there's that small to mid-sized business area. They have very little margin of error in a lot of cases where changes to the economy, a slowing of consumption, higher input costs, et cetera, really impact their profit margins very quickly versus these big, large companies that have a little bit more breathing room.
Right. And I think it was in the NFIB survey that the outlook hit a 48-year low, or an all-time low. I don't think the survey even existed 48 years ago. Hit basically a 50-year low. Right. And employment in the ADP report for small businesses fell by 150,000 jobs. It was more than offset by large companies. Right. So again, your Apples, your Microsofts are still hiring. And your small companies that are, I would say, are at the front line of the economy. That you look at a Starbucks, and if they sell 5 less cups of coffee a day, I'm not even sure they notice. Your mom and pop shop right next door, they sell 5 less cups of coffee a day. They notice. Mm-hmm. They feel all the little bumps in the road, and they adjust much quicker because of that. They are also much more susceptible to inflation and higher wages, and they don't have as many cushions or as much power in place to leverage in place. So when we start thinking about economic slowdown, it's small business that's going to show us the signs. I think in general, Lance, we have to look at different places this time than we would in a typical economic slowdown. And small business is probably the best place we can start looking.
Absolutely. So one of the things that, I want to talk about after the break in particular is, as we noted, in the show today, is that the markets are only down, 10, 11% for the year. And market's really gone nowhere over the last 9 months, even though you may feel like you've been in a major bear market, right? But you look at a lot of these stocks that are down 30, 40, 50, 60%, what's really happening here with the markets? And is this time actually different than what we've seen in the past? We'll talk about the impact of passive investing when we come back from the break. Interesting comments from Elon Musk and Cathie Wood in this regard. Don't go away.
Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people of the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the truth about life insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Realinvestmentadvice.com.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. Realinvestmentadvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So we've talked about here on the show previously about the impact of passive investing. In fact, we've written a couple articles about this on the website. Talking about the bloodbath below the surface of the markets that you don't see, because if you're just holding an S&P index fund, again, you're down about 10% or so for the year, and the markets have been basically flat for 9 months now. But below the surface, below the Apple, the Microsoft, the Netflix, the Nvidias that make up 33% of the market cap of the S&P, below the surface, there's been just a tremendous amount of devastation. So what the index is doing and what the markets are doing have actually been two very different things. So we've talked about that, but there was an interesting debate on Twitter yesterday about this impact of passive investing. Elon Musk and Cathie Wood both kind of criticized passive investing in a Twitter thread. And it's interesting, of course, because Cathie Wood runs ARK Investments, which is a bunch of ETFs. But their discussion was sparked, and I don't want to take the conversation a little bit of a different direction because we've already talked about the impact of passive investing on holding up indexes, but a different direction here, because this whole debate was started by Blackrock. Now, Blackrock this whole debate was started by Mark Andreessen about Blackrock. So BlackRock has a huge stable of ETFs that are huge in terms of size. Vanguard as well. They have trillions of dollars under management in these ETFs. Now, remember, the ETF is a structure. You put your money into the ETF then takes it and buys the shares of the underlying companies. So if you want to buy an S&P, BlackRock S&P index fund, it then buys the shares of Apple, Facebook, Netflix, Google. It buys all 500 companies in the S&P and puts it inside the ETF. Now, BlackRock is the investor in those companies. So if BlackRock has trillions of dollars invested in Apple, they have a voice on the board of directors of these companies. And this is one of the issues that Mike and I have talked about before, specifically relating to this ESG, this environmental social governance type investing. People want to vote their virtues, so I want to save the planet, so I'm going to invest in this ESG fund. It has nothing to do, you buying shares of Apple or Google or whatever that are ESG friendly have nothing to do with the environment. It just basically puts more money with these companies. Well, a lot of these companies are owned by those ESG funds, which are owned by BlackRock. So, what the criticism here is that this move to passive indexing has gave a handful of major institutions like BlackRock, Vanguard, and others an outsized voice on the direction of companies. So, for instance, ExxonMobil as a good example of this. ExxonMobil recently had to give up board seats to a little tiny company called Engine No.1 that knows nothing about oil and gas drilling. They know nothing about the petroleum industry, but they got 2 seats on the board of directors to promote more ESG-friendly activities by ExxonMobil, divesting themselves of oil and gas drilling, taking on more green energy type programs, et cetera, which are less profitable, by the way. So how did Engine 1 get on that board? Well, BlackRock and CalPERS out of California, 2 big holders of ExxonMobil stock, pushed their votes to put Engine No.1 into those board seats. So the question, and I'll throw this over to Mike just to get his comments, will we look back and say that we took away the rights of individual investors to have a voice in the companies they actually invest in by this move to passive indexing? Mike, your thoughts?
Yeah, I think to some degree, yeah. But it was always the big institutions that owned and controlled. I think the big difference today is that those big institutions they focus much more on share price and what could the company do to push the share price higher. And I think over the last 20, 30 years, that manifested itself in share buybacks. That was the big activist movement of these large, the Vanguards, the CalPERS, the Fidelities of the world. They push companies, don't worry about investing in your future, just buy back shares. That's what everyone wants. Everyone wants the stock price to go up today. No one cares what it does 5 years from now. Now we're seeing this more, quote unquote, socially conscious of some of these large institutions, and they're telling them, we need you to be ESG friendly. Not because, do you really think these big executives care what Exxon's doing? No. They care about that 25, 30-cent commission that they make every time someone buys or sells a share, buys a share of their ETF.
Well,
so it's profit motivation.
Let me jump in on that because that's an important point you just brought up, and you said 25, 30 cents, share commission. It's the difference is BlackRock has an S&P index fund that charges 0.25% for the expense ratio in that fund. Their ESG fund, which is exactly the same holdings basically as the S&P fund, has almost a 3-time higher expense ratio than the S&P index fund. We've talked about that on the show before. So to your point, it's a very important point, is that these companies like BlackRock and Larry Fink are pushing these ESG funds, not because they perform better. You and I did a graph showing the near 99% correlation between the S&P and the ESG fund in terms of performance. These funds don't perform better, but they pay 3 and 4 times more for the company issuing those ETFs. And I think that is the important point.
So 2 points, Lance. One is that it's probably the same computer running both algorithms to run those ETFs.
Correct.
And it's the same lawyer that wrote the same documents and added a few statements about ESG.
Right.
Right. So from expense perspective, there's probably almost zero difference between the two, but they charge, like you said, about 3 times more. The other thing is that all of a sudden these ESG ETF firms like oil. Yeah. They like oil companies. They think that they're doing the right things, that they're moving into green energy, that they're divesting away from the old stinky pumps and all that stuff. That's not true. That may be true to some degree, and they are doing that. I'm not saying they're not.
No.
What they really like about it is that energy stocks are up, 30, 40% this year?
Yeah.
The market's down 10%, and their performance, if they are not at least up to the benchmark in energy stocks, is lagging.
Right.
So that is what that is. That's called a money chase. That's not called a socially conscious trading decision.
Well, right. And see, you'll know when we make full circle on this is when coal companies start going up 30-40% and they come up with some excuse as to why burning coal is actually energy efficient and good for the environment, and they start putting those companies into those ETFs because of performance. And then, look, this to your point, it always comes down to performance. That's what this is always about, because if your funds aren't, the death of ESG will be the lack of performance, and that's really the bottom line of all this. But one other kind of sideline to this, the other problem with passive indexing, and look, it sounds great for just the thesis is just sit at home, buy yourself an index, and just track the market over time. And look, you'll track the market over time, and you will get the average rate of return over time. But there's also the problem with that from the standpoint that the reason that we're supposed to be investing is not to be average, right? I mean, our goal is not to be an average investor. I mean, we can be average at anything. That's not really our goal. We can be average at work. Is that really our goal, right? But the problem with passive indexing is because now we now kind of shrug off the work of doing the research, looking for opportunities. We just say, okay, well, I'm just in the index, so I miss great opportunities. You may love or hate Tesla. It doesn't matter. The stock has had a phenomenal return over since it was inception. And if you weren't doing your homework and you didn't invest in Tesla and you were just buying an S&P index, you never got exposure to Tesla until well after it had grown up and gotten very big and large in terms of price and market cap valuation when it was actually added to the S&P. So you miss a lot of opportunity to create wealth in the markets by also being passive, because you're just kind of shrugging off the work of what investing is really all about in the first place. Mike, your thoughts?
I would also argue you're misallocating capital. When I'm buying, I have $100 to invest in the S&P ETF. $7 is going to Apple. $0 is going to that cool, unique hydrogen company out of California that thinks they have a way to create energy at zero emissions and at a very cheap cost.
Right.
And those companies are struggling to raise money while money pours into the largest and biggest companies, many of which are just buying back stock and sitting on a ton of cash. Mm-hmm. So it's not just yourself and your average returns. It's the big, broad effect on the economy as a whole and what we are really investing in for our futures.
Yeah, and it's very true. I mean, speaking of buybacks, Apple has spent more now with their latest buybacks announcement. They've spent 60% of $1 trillion. They've spent $600 billion of capital on buybacks. Not innovation of new technology, not coming out with the next new iPhone, iWatch innovation that's going to change the world. Not the Apple electric car, whatever it is. Yes, they're spending money in those areas, but you spent $600 billion in just buying back shares, which is the least best use of capital by any company. That wraps up the show for the day, of course. Mike, thanks so much for joining us. We'll be back tomorrow with Financial Fitness Friday. Get by the website. Check out the Simple Advisor platform. Of course, as always, you can check out our models, follow our research. Mike and I post commentary every week there as well, so specifically for subscribers. That's all at the website, simpleadvisor.com. And, of course, get by the website, realinvestmentadvice.com, for our latest blog post, Mike's latest article on liquidity, the next liquidity crisis from Japan. That's on the website, realinvestmentadvice.com. Send your questions, comments, emails. Have a great day. 3 minutes on markets and money coming right up.